Уважаеми дами и господа, добър ден! Казвам се Атанас Georgiev и съм заместник декан на Стопанския факултет. От името на ръководството на Стопанския факултет ви приветствам днес. Добре дошли на съвместното събитие, което организираме с представителството на Международния валутен фонд в България. За нас е огромна чест да сме домакин на това събитие, като институция, която подготвя едни от най-подготвените кадри в областта на макроикономиката и финансите. И сме изключително благодарни на екипа на Международния валутен фонд за това, че избраха нас за свой партньор за днешното събитие. Благодаря ви за това, че сте днес с нас и бих искал да дам думата на господин Хайденберг да представи панела. Заповядайте.
Professor Georgiev, members of the diplomatic corps, distinguished guests, well, it is a great pleasure to be here at the Sofia University to present the latest issue of the Regional Economic Outlook prepared by the European Department of the IMF. I will be very brief just to leave the floor to the speakers and the discussants. First of all, on behalf of the IMF European Department, I would like to thank the university for organizing this event and for providing this very beautiful room for the event. I would also like to thank Iglika Vasileva, who is the local economist in the IMF office here in Sofia, who actually did all the work, or most of the work, to prepare to make sure that this event took place. One thing I would like to say is that in all my experience attending these events, we always had these things in central banks or ministries of finance. So I'm very glad that this time we can do it at the university, that we can extend our collaboration to the academic field. And I'm also glad to see that students are also present here. So going to today's presentation, I would like just to say a few words about the report, about what it is. This is the Regional Economic Outlook. Is prepared. There was the World Economic Outlook that is prepared by the Research Department that covers the whole world. Then each regional department of the IMF prepares a regional outlook, which is produced twice a year. In the case of the European Department, is in the spring and in the fall. Since the last edition, the report covers the whole of Europe. Before there was a period when it was covering only Central, Eastern, and Southeastern Europe. But as I said, the last issue and this issue already covered the whole continent. The structure of the report is typically we have one general chapter on macroeconomic developments with the recent developments and the outlook, and then there are specific chapters on various issues depending on what is the priority at that time. And this time we were going to talk about wage developments and labor market integration in Europe. So I think I'm going to leave the floor to our presenters. We have Sylwia Nowak presenting the chapter on economic developments, and after that we will have Faezeh Raei presenting the chapter on the labor market. So we will have the two presentations one after the other. After that we will have the discussion from our four distinguished discussants that I would like to thank them for their participation. And after that we will have some time for questions and answers. Thank you very much.
Thank you, Alejandro, for the introduction, and thank you to all of you for being here this morning with us. We are very happy to be presenting our work at the Sofia University, and we hope you find it useful and interesting. As Alejandro said, I'll be presenting the conjuncture chapter for Europe, and let me start by explaining that in this work, when we talk about Europe, we cover the countries you see on the map, with the countries in the orange labeled as Emerging Europe, and the countries in the blue labeled as Advanced Europe. Let me start by giving you upfront our key messages this time around. First, Europe is continuing to enjoy strong growth. All countries are growing, activity is firming up in many economies, it's firming up in all major economies excluding United Kingdom, and the outlook is generally good. However, some leading indicators, some high-frequency data, suggest that perhaps we are approaching the peak of this business cycle. That having said, if we look at inflation and wage growth developments, they are still not there yet. Inflation has been sluggish and wage growth has been relatively weak in advanced Europe. It was definitely weaker than emerging Europe. And our analytical work that Faezeh will discuss in greater detail suggests that this is due to slack in the labor market, flatter Phillips curves, as well as entrenched low inflation expectations. So what does it mean for policymakers? Looking at monetary policy, we think that it should remain highly accommodative in major advanced economies until the inflation targets are met and inflation expectations are reset. But that, of course, will have implications for capital flows and for exchange rates, and therefore for the pace of monetary policy normalization in emerging Europe. And we'll be talking in greater detail about those difficulties. As to fiscal policy, we think that given where we are in the business cycle, fiscal deficits are still too high and public debt too high in many economies in Europe. Those are good economic times, so this is time to withdraw slowly the fiscal accommodation to prepare for the days when we will need to boost economy again. So we think the policymakers in Europe should really use these good economic times to push with reforms that will help rebuild buffers, rebuild resilience of the economies, but also boost potential growth moving forward. So we have this saying that you should fix the roof when the sun is shining. The sun is shining today in Sofia as well this morning. So let's do that because one day the rains will come, that economic recovery will change, and we need to be ready for those. So a few minutes, let's talk about the recent economic developments and how we see the outlook. As I said, Europe continues to enjoy a strong economic growth. So what you see on those two charts are real GDP growth rates, so gross domestic product growth rates for advanced Europe on one side and emerging Europe on the left-hand side. And we're showing you in the bold lines the weighted averages, where we weight by the size of the economy. And then the shading area is showing the dispersion of growth rates for advanced Europe on the left and for emerging Europe on the right. So for advanced Europe, activity has strengthened in 2017. Economic growth was about 2.4%, up from less than 2% in 2016. As I said, all economies are growing for the first time since the global financial crisis. And the dispersion of those growth rates, so how much variation we see in how quickly economies are growing, is the lowest since the global financial crisis, even before that. The same holds true for emerging Europe. Here, growth in 2017 was 3.7%, it more than double compared to 2016, and it's the highest in 6 years. And notably, Russia grew about 1.5% last year, from contracting in 2015 and 2016. And again, the dispersion of growth rates is the lowest in more than a decade. So the economic news coming out from Europe are generally good. And the other good thing relates to what's driving this growth. And the good thing is it's driven by domestic demand. So here you see the main components of growth for, again, advanced Europe and emerging Europe. And in advanced Europe, growth has been relatively balanced. Consumption, this is what's shown in blue, was the main contributor, but investment and net exports also contributed positively. In emerging Europe, the story is a bit different. Consumption was again the largest contributor to growth. It more than doubled compared to the previous year. And there was also a push from investment. Investment in new EU member states, as you are aware, is related to the fact that we have the new round of EU structural and investment funds. So this is supporting. However, the contribution of net exports, which we are showing here in green, has turned negative in 2017. So given those recent developments, we made revision to our growth forecasts. We make those revisions on regular basis 4 times per year, and we publish them in the World Economic Outlook. So you can see that for both advanced and emerging Europe, we revise growth upwards, and those upward growth revisions largely reflect stronger domestic demand. So in advanced Europe, again on the left, we revise growth by about 0.5 percentage point, which is quite substantial this year, and about 0.3 percentage point next year. And those revisions are driven equally by consumption, again in blue, and investment, which we are showing in orange. The stars are showing, not sure whether you can see them, yeah, I think you can see them. So the stars are showing what we think would be the overall growth in advanced Europe. This year it will be around 2.3%, and we expect around 2% in 2019. Moving to emerging Europe, that's on the right, we revise growth upwards by similar amounts, but we expect less support from the net exports. We now expect emerging Europe to grow by about 3.1% this year and about 2.7% in 2019. Now I want to point out that almost half of those revisions for both advanced and emerging Europe are due to a higher investment growth, and this is very positive news. This means that growth is becoming more and more solid. Now, you might be asking yourself, should we expect further upward revisions? And the answer to this is perhaps not. So there's a number of different high-frequency indicators that we are monitoring, and the chart on the left-hand side is showing manufacturing purchasing managers indices, which is basically a measure of business sentiment around the producers, what they think will happen in the future. And you can see that for both advanced and emerging Europe, those indices are very firmly in the expansionary territory. Sure. Is it better now? Thank you. Do I need to repeat something? Or you can refer to your slides? Okay, thank you, Igniti. All right, so looking at the business confidence indicators, as I said, they are firmly in the expansionary territory, but they kind of have softened in March and April since the long string of gains. So for example, for Euro area composite, the decline since the end of 2017 was around 2 points. This is a large decline. The last time we saw something like that was in 2012. For Turkey, this indicator actually turned negative, so showing no longer expansion in April. On the right-hand side of the slide, we are showing Citigroup's Economic Surprise Index. So this is a composite measure of how markets are surprised by macroeconomic announcements. And in the light blue, you see the average for 2017, and in the dark blue, the data for March this year. And you can see that there are fewer upside surprises this year than we saw last year, especially for the Euro area that's at the very bottom of this chart. Those surprises were clearly on the negative side in March, and this is something that we saw when the Q1 data came out for real GDP growth in the Euro area. Now, those are of course our point forecasts. We don't claim to be able to forecast future perfectly, so we know, that the number can be a bit higher or lower, and we want to talk what are the risks to this forecast. And so in the near term, we think those risks are quite balanced. Confidence is still robust, leading indicators are still strong, so growth still could surprise us on the upside. That having said, greater trade tensions and market volatility could weigh on growth negatively. So we think on balance in the near term, at least the likelihood of more positive surprises is smaller than it was a few months ago. Now, in the medium term, risks are clearly tilted to the downside, and they become more acute in the recent months. Some of those risks we've been discussing with our member countries for a while now. They are related to the rise of protectionism, inward-looking policies, and the negative impact of protracted policy and political and economic uncertainty on growth. Now, we are becoming also increasingly more concerned about the impact of sudden tightening of global financial conditions. Now, those financial conditions have been very easy for a while now, despite the fact that the major advanced economies have started monetary policy normalization. But as the recent events show, there were episodes of market volatility in February, and later April, early May. So we know that this sentiment of financial markets can change very quickly. So we wanted to quantify this effect, and we did a little exercise where we looked at the 25 years worth of data for major advanced economies, and we looked at what happens to growth and inflation when there's a large drop in stock prices. So this slide illustrates briefly our findings, and the details are in our report. The chart on the left-hand side is showing impact on growth of this large decline in stock prices. And you can see that 1 quarter after this shock, growth declines by about half percentage point. But the bands of this impact are quite large, so the impact could be much more negative. Now, 2 years later, that's the orange bar, the average impact is around 0. That tells us that activity has recovered. Now, the opposite is true for inflation. The impact on inflation 1 quarter after the shock was very small, but after 2 years it becomes quite negative and substantial. And this is really a source of concerns because monetary policy today has definitely less space than during the global financial crisis to respond effectively to the lower inflation. Policy rates are still very close to the zero lower bound. Policymakers are engaging in orthodox policies, so we just don't have space in the monetary policy to respond to that kind of shock. And that is kind of a preview of what we'll be discussing when we talk about fiscal policy, because we will need fiscal policy to help to respond to such a shock, should this shock happen. Now, before we move on, I want to make sure you know, this is not something that's specific to Europe, but if such a shock happens globally, Europe will be affected. But before we move to policies, let's talk briefly about cyclical position and inflation. So I'm starting here with a map of Europe that's showing output gaps. So you might recall that output gaps are measuring a difference between potential growth, so how economy could be growing if all the factors were employed, all the resources were employed, and what is actually happening. And this is something that we cannot observe, so we have various methods of estimating output gaps, and those estimates are uncertain, and they are at times revised, so we know that. But that having said, our estimates suggest that the output gaps have been closed in Europe, and in Central and Eastern Europe, they have been closed for quite some time now. So what you see on this map is a lot of green. There's a lot of green, as I said, in Central and Eastern Europe. Many countries in the euro area also have positive output gaps, so they're growing the potential, the actual growth is above the potential. And there are only a few exceptions. For example, Greece is still having negative output gap. Moving to inflation, despite the strong activity, despite the closed output gaps, inflation is still relatively sluggish. So those three charts are showing core inflation for different country groupings, and this is year-on-year percentage change that we are showing in percent. On the left-hand side, you see advanced Europe, and you can see that inflation in the euro area, which we are showing in blue, remains very sluggish, and it actually declined in April. The same is true for the Nordic countries, which we are showing in orange in this chart. By contrast, core inflation in other advanced economies, that's the green line, has increased appreciably. Other advanced economies, we put here a bunch of countries, and it's mostly the United Kingdom, Switzerland, Czech Republic, Israel, and this increase in the other advanced economies reflecting inflation of about 2.5% in the UK, which reflects a depreciation of sterling. Now moving on to Central and Eastern Europe, that's the middle chart. You can see that core inflation has also been sluggish, but it picked up more noticeably than in advanced economies. There were some recent declines, but we think they are temporary and related to energy price-related base effects. Now, on the right-hand side, in Russia, inflation declined even further. In Russia, monetary policy is very tight, but it increased very strongly in Turkey. In Turkey, macroeconomic policies are expansionary, domestic demand is very strong, and lira also recently depreciated, and this is what we are seeing in the inflation. So all in all, we see that in most of European economies, inflation has been low, but it increased, especially in the Central and Eastern Europe. And this increase is consistent with what we see in the labor market. So I'm going to give you a preview of the chapter that Faezeh will discuss in a greater detail, because it fits with our narrative about what's happening now and what is our policy advice. And I want to point out that for this part of the analysis, instead of talking about advanced Europe and emerging Europe, we're looking at the EU and we're dividing countries into old EU member states and new EU member states. Old EU member states are shown as EU 15, and those are the countries that joined before 2004. It just makes a little bit more sense from the economic perspective of this part of the analysis. So first of all, we see that labor market slack has declined in Europe, but remains high in old EU member states. So here we are showing you a broader measure of the spare capacity in the labor market. It's not only the usual unemployment rate, but we are also including people who are marginally attached to the labor force, or people who are employed part-time and would like to work more hours. So if we take this broader measure of spare capacity in the labor market, you see that it has declined in EU 15 countries, that's the blue line, but it still remains above the pre-crisis level. Now, if we look at the new EU member states, this decline has been very steep recently, and now the labor market slack is actually below the pre-crisis levels. And this, of course, has impact on wages. So wage growth has been very sluggish in old EU member states. It was hovering around 2% for quite some time now, whereas it picked up very noticeably in new EU member states and is now approaching 6%. Now we have this cool slide here about factors driving wages, but Faezeh explains it way better than I do, so I'm going to leave it that for her presentation, and this way you don't have to listen to it twice. So let me skip that and talk instead about implications of this wage growth on external positions of new member states and competitiveness. So what we are showing here are the current accounts for new member states, as well as increases in export market shares. So you can see from the chart on the left-hand side is that current account balances in new member states are in much better position than before the crisis. Countries in this region had very large current account deficits before the crisis. Now there are either surpluses or much smaller deficits. And you can see also by looking at the dots that those external positions are stronger than what we estimate to be the current account norms. So when we talk about the current account norms, those are the orange dots in the chart on the left-hand side. They come from our external stability report, which we publish annually, where we look at the exchange rates and current accounts of member countries, and we want to see whether they are in line with fundamentals. So the dots I'm showing here are a bit dated because they come from our 2017 report. We'll have a new one in the summer, and we are revising the methodology. So the gap between the actual current account and the norm might be different, but all in all, we can see that the current accounts are quite strong right now and much better than they were before. Now, consistent with this, if you look on the right-hand side, you can see that all new member states increased their export market shares compared to where they were before the crisis, despite the recent wage growth. But this is not to say that there is no impact on competitiveness. So the chart on the left is showing real effective exchange rates based on unit labor cost. So this is like a weighted exchange rate that's taking into account the relations with trading partners of a given country and also taking into account cost of labor in this country, okay? And you can see that those real effective exchange rates really increased recently, especially in the Baltics, as well as the Southeastern European countries, for example, in Romania. Now, we didn't see really impact on competitiveness yet. You saw that this export market shares actually went up. And one of the mitigating factors is shown on the right-hand side. You see here that as wage growth went up, that's the orange line, corporate profit shares went down. And that basically tells us that the companies in the region still have sufficient comfortable profit margins to absorb this higher wage growth. But they won't last forever, and competitiveness is something that needs to be watched. Now, if we look at the euro area current account, it's still also broadly in equilibrium, as estimated in our 2017 report. Deficits are shrinking, but they are shrinking for the euro area as a whole because of deficits countries improving their external positions. In many cases, that was the result of import compression. In contrast, you can see that the top line stays around 10% more or less, and this reflects very strong current account surpluses of countries such as the Netherlands and Germany, and they haven't really changed recently. So what does it all mean for macroeconomic policies? Let me start with monetary policy in advanced Europe. We think it should remain accommodative for quite some time now in most of advanced Europe. First, for the euro area, we see a need for maintaining a highly accommodative stance until inflation is durably increased toward the ECB target. The chart on the left-hand side is showing you in the blue line that inflation expectations in the euro area are still very much below the target. That's your dotted line. And the chart on the right-hand side is telling the similar story. Here you have market expectations of increases, and markets anticipate only a very marginal increase in the policy rate. We also see, in similar manner, room for continued accommodation in Sweden. And now in the UK, inflation is already above the target, and inflation expectations are moving in line with the target. So markets do expect future policy increases, and we think that those policy rate hikes should be guided by evolving inflation conditions and also the need to deal with the uncertainty posed by Brexit. In new member states, policymakers, because of what's happening in advanced Europe, are facing particularly complex monetary policy challenges. As we saw in the earlier slides, those countries are much more advanced in the business cycle, output gaps are largely closed, and inflation pressures are building. So we think monetary policy in those countries will have to tighten sooner than in advanced Europe. And that will have implications for capital flows, for exchange rates, and new policymakers in the new member states will have to be mindful of it. We don't want the competitiveness to suffer, and we don't want growth to become unbalanced again. So that means that we need a better policy mix with tighter fiscal policy in many of those countries to help sustain balanced growth. So let's turn to fiscal policy. Here is a very high-level summary picture of fiscal policy stance in European economies. So this is basically counting what share of countries have maintained broadly neutral fiscal stance, so that's in gray, or tighten, that's in orange, or in contrast when fiscal policy was expansionary, and that is shown in blue. And you can see that as the economic growth has became stronger and stronger, actually fewer and fewer countries have withdrawn fiscal accommodation. Fiscal policy became pro-cyclical. Some countries in Central and Eastern Europe, for example Hungary, Romania, Turkey, they clearly have had expansionary fiscal policy for over the past couple of years, despite the fact that the economic activity is very robust. In Poland, last year there was some small fiscal adjustment, but it was not sufficient given the solid state of the economy. So, we think that many countries are basically not taking sufficient advantage of the good times to rebuild room for fiscal maneuver, which is not what we recommend. So here are our fiscal policy priorities. For advanced Europe, we think this is a great opportunity to use the good times to rebuild fiscal buffers in countries that have high public debt. But in countries that have fiscal space, focus should be on lifting potential growth. In all cases, countries should focus on improving policy mix to make it more growth-friendly, including by preserving public investment and improving the efficiency of the government. Our policy advice for emerging Europe is very similar. Rebuild fiscal room to deal with future shocks and reduce pressure on monetary policy or help out monetary policy. And this is particularly true in those countries in Central and Southeastern Europe where fiscal policy has been procyclical for some quite time. Now moving on to financial policy priorities. For many countries in the region, progress has been made on cleaning up bank balance sheets, but more remains to be done. So in this chart, what you see on the horizontal axis are non-performing loans. And orange dots are for emerging Europe and blue dots are for advanced Europe. And you can see that those NPLs still remain high in several countries, noticeably in emerging Europe. Now reducing NPLs will help credit growth, which we are showing here on vertical axis, and that will support economic recovery, and it will also make sure that the European banks rebuild their profitability and become healthier. So policymakers should continue to address the remaining balance sheet weaknesses, and in those countries where house prices are now high and rising, macroprudential frameworks should be used to reduce those vulnerabilities. Let's move to structural policy priorities. We estimate that potential growth has declined since the crisis, as you can see in the chart here. And this is something that we've highlighted for some time now, and discussions of concrete structural policy reforms are unique to countries, and we discuss them with country authorities in the context of our Article 4 consultations with membership. But the broad themes are as follows. For advanced Europe, the focus should be on labor and product market reforms that will help close competitiveness gaps on the national level. For emerging Europe, some of the key priorities are to strengthen institutions, improve public sector efficiency, and boost labor force participation. Now, I spoke earlier about using the good times to move ahead with reforms that will boost resilience. We think this is also a good time for policymakers at the EU level to strengthen the EU architecture. There are three critical areas where actions are needed, and they relate to the banking union, capital market union, and fiscal institutional reforms. So for the banking union, we think more actions are needed to complete the banking union, and that will require instituting a backstop from the European Stability Mechanism to the Single Resolution Fund, and setting up a European deposits insurance scheme with a fiscal backstop. All in all, those actions would mark an important step toward greater risk sharing. Now, advancing capital markets union would provide small and medium-sized enterprises in Europe with more choices of financing their investment by increasing the investor base. Capital market unions would also involve promoting harmonization of insolvency regimes and protecting cross-border investors' rights. And finally, with respect to fiscal institutional reforms, we recently published a staff discussion note on central fiscal capacity, which would support macroeconomic stabilization in the euro area. We provided in our discussion note ideas on how this central fiscal capacity could be designed so that there are strong safeguards against permanent transfers and moral hazard. And if you are interested in this, I would refer you to this paper. So let me stop here. Thank you for your attention, and over to Faezeh.
Okay, thank you very much, ladies and gentlemen, for coming to this presentation. My name is Faezeh Raei. I'm going to present the findings of our second chapter of the Regional Economic Outlook. This chapter has more of an analytical nature. The first chapters usually are about the conjunctural development. In the second one, we usually go into more detail about one of the topics of interest. In this round, we are focusing on wage developments across the Europe and their determinants. So let me offer first a very brief overview of what is it that we are finding. So here I am showing some key messages. Overall, what we find is that across the whole European Union, there has been a lot of improvements in the labor market. For the purpose of this chapter, we are focusing on European Union because of better data availability and more uniform data, basically, across these countries. What we see is that within the European Union, there are divergent developments across two sets of countries. One group that we call the EU 15, or the older EU members that joined European Union before 2004, they tend to have lower wage growth, more subdued wage growth. So these are, for example, countries such as Germany, Austria, Belgium, France, Netherlands, Denmark. So in these groups, wage developments are weak, despite the fact that employment has grown or unemployment has gone down. In the newer member states, which includes countries such as Bulgaria, Romania, Czech Republic, Hungary, Poland, and some of the Baltics, they are actually experiencing quite more stronger wage growth. So what we delve into is that what drives these differences in wage developments. That's the focus of this chapter. We look at a host of different factors, and what we find is that for the older member states, the inflation, low inflation and low inflation expectation, as well as low productivity growth are the main drivers, while in the newer member states, the wages basically mostly are driven by the tighter labor market, so to say, and less room or less slack in the labor market, as well as some spillovers from integration in EU. So I'll explain that a bit more in detail. So these different dynamics, these different factors that drive the wages, they also have different policy implications that towards the end I'll get into that. So why wages? Why are we focusing on wages in this chapter? You've seen a different presentation of this chart in my colleague's presentation. Here we are showing unemployment rates. On the left-hand side, we are showing unemployment rate in the older EU member states. On the right-hand side, unemployment rate in new member states. And the shaded area, they represent the 25 to 75 percentile of unemployment rate across that group. So overall unemployment rate, as you see, they peaked after crisis. In the old member states, they increased a little bit after crisis. They again increased more dramatically after the Eurozone debt crisis in 2011-12ish. And then after 2013, they start to come down. In new member states, you see that they peaked right after crisis, and then more gradually they started to come down. What you can see also, I want to highlight, is that the unemployment rate at current point in 2017 in older member states is still above the pre-crisis level. So basically, there is still are some people that are unemployed more than pre-crisis time. So as we technically say, the labor market is slack, or room for hiring more people is still there. But this is in contrast to new member states. The unemployment rate here is basically below pre-crisis levels for many countries in new member states. So to say, labor market is slack, or room to hire more people has declined and is becoming tighter and tighter. So despite the fact that this, so to say, slack or room to employ has declined, we don't see much wage growth. So here I'm showing wage growth again in the old member states on the left, and on the right, new member states. For the old member states, wages were growing around 4% on average pre-crisis, and now is around 2%. New member states around 10% before, and after crisis they were hovering around 4% until around 2013, where it started to pick up a bit faster. Still the levels are below pre-crisis level. So what we ask in this chapter is that why do we see these different wage developments despite the fact that both group of countries, labor markets have improved in general? And so why is the difference? And also, especially in the old member states, why the wage growth is still so anemic? So there are many different factors, basically, many different hypotheses. This topic of subdued wage growth, especially in old member states, has been studied in different institutions in IMF as well as academia and other international institutions, that why wages are not growing. There are several hypotheses. One is that perhaps the labor market is slack. As we measure it through unemployment rate, maybe is not a proper measure. So it could be that there is more room to employ people. So there are, for example, there are many part-time workers or people that are marginally attached, and because of that, the wages are not growing as much. That's one hypothesis that has gained some traction recently. So we wonder to what extent that's a factor. There are other hypotheses in a sense that maybe the relationship between the labor slack and wages have changed. So to say the Phillips curve, maybe that the coefficient in Phillips curve has changed, or Phillips curve is dead, or so you might have seen this literature as well. There are some other factors, for example, within Europe, the integration and the fact that labor markets are integrated as well as product markets are integrated through supply chains also raises question that maybe wages in older member states are not growing as much because of perhaps immigration from within Europe, within European Union, and maybe wages are not growing as fast because perhaps production is outsourced. That's also one factor that might be at work. There are other hypotheses like the fact that inflation has been subdued as well as productivity has not grown much. So there are basically typical determinants of wages. So maybe the reason is that. So what we do in this report is that we try to make basically make sense of all of these different factors and try to see which one of them seems to be at work here. For example, the last two, productivity and wages, they on their own, they have a lot of explanatory power, for example, especially in the older member states. Here we are showing, both of the charts refer to old member states. On the left-hand side, I'm showing a measure of inflation. It's a GDP deflator inflation, which is more relevant here. So we see that pre-crisis it was 2.5, after crisis 1.5, so it's declined by 1%. On the right-hand side, you see that labor productivity also has declined. It has declined again by a 1 percentage point. So when you add it up, you could see that they maybe explain the 2% decline in the wages, on average wages in the EU member states. So they seem to explain some of it, but still some question remains about what is the role of relative role of each of these. But in the new member state, here I'm showing the same things, inflation as well as the labor productivity for new member state. Here again, the inflation is lower and labor productivity is lower. However, we see that in new member states, the wages actually have been picking up strongly after 2013. So here there is a bit more puzzle that these two traditional drivers don't seem to be capturing the whole picture. So let me summarize the introduction in a way. We kind of, basically there are some traditional drivers of wage growth, the so-called labor market slack, or how much room there is in the labor market. There are inflation and productivity that on the left-hand side we are showing. They all go into wages. But all of these, they could also have, if you look at it from a different point of view, they could have domestic component, or they could all be driven by some external phenomena, for example, the global crisis or some external development. So they could have components that are domestic and can be affected by domestic policies, or they can be basically external factors. And from a policy angle, this is important for us for policy advice to what extent each of these are driven by domestic or external. They have different policy implications. So what we try to do is to merge these two separate narratives that are common in the literature, try to bring them all together. So specifically, these are the questions we would look at, is that how important are all of the traditional drivers, the three slack, inflation, productivity, but also we ask that given EU integration, how important is this angle of spillover, so to say, for wage dynamics. And we also ask, is there the concept of a slack labor market slack, is that the right one that we are using, or we need to expand that? And after we take account of all of this, what are the policy implications? So with that, let me highlight a couple of new angles that we are going to consider in our report. So as I mentioned before, there's been a growing literature on wage developments, especially in the Western Europe, not so much in new member states, and they typically they consider the traditional drivers. Here we are focusing on two additional angles that we are incorporating in our research. One of them is this expanded measure of a slack that we're going to use in our regression framework. What does this mean? Is that the typical unemployment may not be capturing the extent of, or the strengths of how much people want to work. So in the left-hand side here, I'm showing a chart. The blue line is showing unemployment rates, a traditional one, for advanced, for old EU. The red line is showing the underemployment rate, or non-employment rate, so to say. And in addition, that incorporates, in addition to unemployed people, it incorporates people that want to work more, but they are not able to do so because of economic conditions, or people that are part-time. So we see that there is a huge difference between the two for old member states. While unemployment rate in 2017 is around 6 or 7%, the underemployment rate is around 14% or so. So this suggests that there is more room for people to be hired. This is quite, somewhat different in new member states. So the blue line unemployment rate is hovering around 6% or so, and then the underemployment rate is closer to 10%. So we see the difference is not as stark, and also in this case, both of these indicators, they tend to be lower than before. So that again suggests that labor market is slack here. There is less of it here. So this is one measure that we incorporate in our regression analysis instead of unemployment rate. And to give you a bit of preview, we see that for new member states, this actually is important, but for older member states, while it's significant, the contribution in the regression doesn't seem to be that much. So one other new angle that we try to incorporate in our analysis is the EU integration angle. Why is that? Why do we incorporate it? Is that for labor supply and labor demand, EU is very much integrated. For example, through migration, the labor supply is not limited to the national borders, but it has to be looked at from the EU perspective. So here, for example, if you look at the red line, this is showing the stock of immigrants from new member states to old member states. And we are showing it as percentage of new member state population. So what does it mean is that, for example, in 2017, it's around 8% of the population of new member states have immigrated to old member states. So that's a pretty large number, and it represents a big shock to the labor market of new member states. So you could expect that it might have implications for wages and labor supply there. We are also in the blue line here. We are showing the same variable, the stock of migrants from new member states to old, but we are showing it as a percentage of population of the older member state, the destination countries. So as their population is slightly lower, it's at 2%, so although it's not negligible, it's not that large, and actually in the analysis we see that the impact on the old EU labor markets from the migration is not that big. So this is basically is showing the importance of the importance of integration from the labor supply perspective. Here we are looking at importance of EU integration for the labor demand perspective. So what I'm showing here on the left-hand side, we are showing a network of supply chains in the world, so to say, and a lot of them are actually European countries. What we want to highlight is that the production of goods and services has become increasingly fragmented across countries with supply chains. Parts of goods are produced in different parts, so that means that the demand, once something is going to be produced, the demand for the labor is not restricted to the country of export, but actually it's the demand for labor is spread everywhere. So Europe in particular is tightly knit, especially through Germany as a hub, and there are a lot of linkages, not only within the bigger EU state, but also new member states. They are highly open economies and they are very much integrated into supply chain. So what does it do for labor markets? As I mentioned, as global economy grows and demand for goods and products from EU increases, that demand translates into demand for labor in new member states. So that means that the conditions in new member state, labor market condition, new member state, they become sensitive to global conditions. So on the right-hand side, we actually see a measure of this sensitivity. So the red line, for example, it shows the sensitivity of new member states' local labor market conditions to global conditions. So that's kind of higher than the sensitivity of the older member states. And it has increased quite a lot from pre-crisis. So to summarize this, EU integration seems to, at least in principle, have the channels through which it could affect labor supply, labor demand, as well as wages and local market conditions. But one question remains that, yes, in theory there are these channels, but how important are these spillovers from EU integration? Are they worth including in the regression frameworks or not? So what we do is that we do a small analysis outside of our regression frameworks to just see whether the external or spillovers are important. So here I want you to focus only on the two left columns. Here what we have done is that we decompose wage dynamics in each country into domestic factors as well as non-domestic factors through some purely statistical methods such as factor dynamics. So the big chunk, the big stacked bar that you see are the domestic factors. So one could say that wage dynamics in EU15 to a large extent are driven by domestic factors, but there is also a role like 30% for non-domestic factors. The same is true for new member states. Around like 30% or so, there is a role for a spillover. So this kind of gives us a bit assurance that the channels that we are looking for in integration, they also matter for wage dynamics. So how do we bring all of this together? So far I've shown that there are different factors that matter in principle for wage dynamics, and there is also a role for a spillover, and they seem to be significant. What we do is that we have a wage Phillips curve framework, which is standard in the literature, and we try to augment it with this new dimension. So here I'm showing like the first formula is the traditional wage Phillips curve that is the workhorse for this paper. It's linking the nominal wage growth to the three factors: productivity, inflation, and labor market slack. We're going to add the two new dimensions. The first one is highlighted in a box. So instead of the usual unemployment, we're going to use underemployment gap. And the other angle that's again highlighted in the second box is that this wage Phillips curve, we are adding some variables that have to do with wage developments in other countries in order to capture the spillover, and also the unemployment rate in other countries, for example, the unemployment rate of the whole euro area. We're also adding the migrant flows, because as we discussed in the context of migration and EU integration, that also affects nominal wages. So the last specification here is the regression that we are running for different countries in order to see what's the relative contribution of different variables to wage development. So let me give you a bit of highlights of the results. The first one is that, as my colleague mentioned in the earlier presentation, the wage Phillips curve seems to be alive. So the coefficient of slack, basically is what people refer to as the main coefficient, and whether Phillips curve is significant or not. We see that that coefficient is significant both for older EU member state and the new one, but the slope is quite different. It's very steep in new member state. That means that once unemployment declines and the slack in labor market declines, that translates faster to wage growth. However, this translation to wages for older member state is going to be slower, so there's less sensitive to wages. So another thing that the regression framework gives us is the contribution of different factors. So here I'm showing what are the contribution of all the factors in that regression to the actual wage growth in old member states in the year 2017. The actual wage growth is the red dot, and the bars represent different variables. So here you see that inflation, for example, has the biggest chunk of explanatory power, after that productivity. And there is a little bit of room for domestic, for the slack labor market. This low contribution also has to do with the very small coefficient that we saw in the previous slide. So for all member state, inflation and productivity, the traditional drivers, they seem to be explaining a big chunk of the variation. And also the spillover, we don't see a big contribution for it here in this chart. Let me jump to this slide. I skipped one of the slides in the interest of time. For the new member states, what is the relative importance of variables? Here, the difference, the important variables are different. We see that slack seems to be the biggest contributor. So basically, tighter labor markets in new member states, as we mentioned earlier, they seem to be driving wages up. There is also some room for spillovers from EU integration, as we described before. They also seem to be driving wages up. For productivity, there is some room for productivity and inflation as well as the traditional drivers. So that there is quite a difference with the old member state. So we have done some other analysis in the report as well. For example, the pass-through from wages to inflation, so it's kind of a mirror image of what we have done so far. But in the interest of time, I'm going to just very briefly mention that what we find is that the pass-through from wages to inflation, it is positive, but it's relatively robust. You don't find a one-to-one pass-through from wage to inflation. Find it to be around like 30% or so in the long run. It's done through a VAR, standard VAR analysis. I invite you to take a look. So that has implications kind of for policy as well. So let me jump into the policy implications. What is this different in drivers of wage development means? So what we have established is that a wage Phillips curve is alive and well, meaning that the decline in unemployment rate would eventually lead to higher wages, but it will be slower in older member states, and it will be faster in new member states, as we have already seen in a stronger wage growth in new member states. The drivers are different in old EU. Inflation and inflation expectation and low productivity, they are behind the low wage growth. So the policy implications would be that in order to raise wages, important to also basically ensure that inflation goes up to and reaches the target. So a commitment to the commitment of monetary policy to ensure that the inflation, reaches the target is the policy there. For the new member states, we see that tighter labor markets and the spillovers from integration in EU are the ones that are driving wages mostly. So the implications here would be different in a sense that if we see tight labor markets, maybe through immigration or through shortages of skilled labor are behind the labor market, then the policies would have to do with trying to activate more of the labor force and try to ensure that there is enough supply of skilled labor. So there's more of the structural policies that have to do with ensuring that the skilled population is, is provided through basically better education as well as activation policies where the participation rates of parts of society that are not participating that much in labor force is increased through labor market policies. There is also the angle of skill mismatches in a sense that there may be a lot of skilled labor, but the skills might have become outdated. So again, there is role for labor market policies to reduce those skill mismatches to support further labor force participation. We have a box in the report that looks at the experience of more advanced countries, the ones that have been successful to increase labor force participation. I invite you to take a look at that to get more tangible examples of what are the type of policies. So with that, I think I conclude the presentation of Chapter 2. We're very grateful for distinguished discussants, so I leave the table. Maybe Alejandro, you can tell us the order. Right, thank you.
Okay, thank you very much, Sylwia and Faezeh. I think we're going to start with Ms. Vladova.
Good morning, everybody. First, I would like to thank all the organizers, both from Sofia University and the International Monetary Fund, for the invitation to participate in this presentation. So, as you remember, the first chapter dealt with the overview of recent economic developments in Europe. Also, it presented the outlook for the region, both the short-term and medium-term risks, as well as monetary, fiscal, financial policy recommendations and policy recommendations related to the economic and monetary union in Europe. First, I will start with a short comparison between the BNB staff latest macroeconomic projection and the macroeconomic projection which is presented in the regional economic outlook on Europe. I think that this could be interesting, even though the specific details of the forecast on Bulgaria were not part of the presentation. So our latest macroeconomic projection is as of the middle of March, and according to this projection for 2018, we have actually one and the same number for real GDP growth. It is 3.9%. However, for 2019, we have stronger growth compared to the IMF. We have 3.8 compared to 3.1. And so our projection is based on latest assumptions about strong global growth continuing well into 2019. Also, we have strong domestic demand in an environment of ample liquidity, remaining low interest rates, and relatively low inflation. As regards unemployment rate, we have low unemployment rate, which reaches 4.7% in 2019, which compares with 5.8% in the IMF forecast. The HICP annual average inflation, however, is very close in both institutions' forecasts. It is at 2% for both years. In general, what I can say is that I agree with the presented overview of economic developments, as well as with the balance of risk which was presented by our IMF colleagues. Now I would like to going to detail into some of the specific issues which were interesting to me, and where I think that the chapter could have benefited if it had provided a little more of a detailed analysis there. As very rightly pointed out in the report, improving economic prospects in Euro area, but especially in Central and Eastern Europe, pose the question of the assessment of overheating pressures and, of course, the appropriate design of policy measures. Similar to the very big uncertainty, which is when we estimate the output gap, it is also very challenging to make an assessment about overheating pressures if we look at a broader set of macroeconomic indicators. Even though the presentation didn't show it, the chapter actually contains a very interesting box which summarizes overheating pressures across the largest European economies based on a number of domestic indicators, financial indicators, and external indicators. And I will brief over them in a few minutes. For some of the indicators, so what is the approach? For example, for the unemployment rate, the current account, and real house price growth, what the chapter does is a comparison between the 2017 values and the average of the values of these indicators over the period 1996-2015. For some other indicators, for example, private sector credit growth and capital flows, what is done is there are selected benchmarks with which these indicators are compared, and these benchmarks are one and the same for all the indicators mentioned, namely capital flows and private sector credit growth. Against the background of this analysis, a very important question, at least in my opinion, arises, and this is first, to what extent the macroeconomic developments, especially in Central and Eastern Europe, over the period from the beginning of the 1990s to the middle of 2007-2008, where all we know that there were very strong, very substantial structural changes. For example, EU accession, there were relatively high capital inflows, financial deepening, there was an acceleration in the catching up process. So to what extent these developments actually allow us to make an assessment about overheating pressures at present? And is there any risk that we underestimate overheating pressures if we look at data up to 2008? At the same time, if we compare real GDP level with its pre-crisis trend, is there any risk that we make misleading conclusions because of the structural changes that have happened over time? So I think that a more detailed analysis in this direction could have benefited the chapter. What I can say about current macroeconomic and financial developments in Bulgaria, according to the BNP staff assessment, as you all know, the unemployment rate has gone down substantially. Very strong economic growth coupled with a decline in the unemployment, also indications of tightening labor market, as well as administrative and policy factors, have all contributed to strongly rising wages. At the same time, the HICP inflation remains relatively low. Output gap estimates point to a slightly positive output gap. As regards credit growth, the overall non-government sector credit growth is close to historically low level, however, with differences when we look at household credit growth and non-financial corporations credit growth, where the picture is that the credit growth to household outpaces that of credit growth to firms. As regards house prices, there again, on the front, it appears that house price growth is relatively strong. However, we have to take into consideration that recent developments also reflect the fact that house prices have done a substantial correction since 2008, and they have been bouncing back from this correction. Also, our estimates show that at present house prices are very close to their equilibrium level, so we have done an assessment about which fundamental factors drive them, and we have concluded that at present house prices are close to this fundamental equilibrium level. An essential discussion topic, which is also opened by the chapter, in my view, is box 1.2, which again was not mentioned in the presentation, but I think was very interesting. This box compares the current recovery against the recovery of selected macroeconomic indicators from the 1991 global recession. So what is done is that a set of indicators like real GDP, investment, inflation, I think equity prices, so their dynamics since 2007-2008, both in advanced Europe and in emerging Europe, is compared with the recovery of these indicators since 1991 up to the period of the beginning of the 2000. And so what is the conclusion? The conclusion is that in emerging Europe, where Bulgaria also stands, investment has been very depressed. So its recovery since the global crisis of 2007-2008 has been at much lower levels compared with the recovery of the same indicator starting from 1991. And again, in my view, this comparison is fine, but the issue is how indicative all these developments in the beginning of the 90s could be for future economic growth in the region. And furthermore, we shouldn't forget that there are significant structural changes which are also common for advanced Europe. For example, the aging of the population, the significant advances in the IT sector, which also complicate very significantly the comparison between the two recoveries, the recovery from the global crisis from 2007-08 and the recovery from the 1991 global crisis. As regards fiscal developments, I think that the presented overview could have been a little bit deeper. For example, we saw that there was an analysis of fiscal policy conditions based on the projected cumulative fiscal impulse over the period 2018-2019. I think that this very short overview could have been accompanied with information about budgetary developments over the recent years for the economies, as well as with debt sustainability risks by countries. Also regarding the policy recommendations that euro area countries which have ample fiscal space should undertake measures which lift potential growth. I think that these recommendations need to take into account the cyclical position of these economies, which means that policies which are pro-cyclical should be avoided in cases of a positive output gap. At the same time, compliance with the rules of the Stability and Growth Pact should be ensured at all times. At the same time, I fully agree that the conclusion with improving macroeconomic developments in the region and potential medium-term risks which are tilted to the downside of utmost importance is to ensure the resilience of public finances and to implement reforms which contribute to higher potential growth. Finally, one remark which is on the creation of the central fiscal capacity, which was very briefly mentioned in the presentation. Yes, this is one of the discussed priorities on the road to the deepening of the economic and monetary union. I personally, this is my personal view, find it very difficult to imagine how such a capacity could be built with sufficiently tough and robust mechanisms which are targeted in such a way that they eliminate any moral hazard behavior and also they avoid any disincentives in implementing structural reforms. One issue that I could raise is that for those member states which support the build-up of such a capacity, they could actually set up such a capacity among themselves through, for example, a mechanism of close cooperation. Then, if actually the practice proves that this mechanism among them is working appropriately, which means that none of the participating states which receives any transfer is not permanently benefiting from such a capacity, then I think it will be a strong case for the other non-participating member states to be more willing to join this capacity. And I think that I covered almost all of the issues. There was something which was not presented in the report. It was on the eroding competitiveness in new member states. Yes, the standard view is that if we have wages which outpace productivity, then there is the imminent danger of losing competitiveness. However, what we have seen in the Bulgarian economy is that since the 2000s, with strongly rising wages, responding to productivity growth, but also in line with the catching up process, actually this has not led to any erosion of the competitiveness. We have seen strong positions of our exports, and I think that with the catch-up process, yes, it will take some time so that the strong growth of wages ruins more of the competitive positions of the economy. Still, the labor share is relatively low, and we see that exports are outpacing the growth of external demand, which means that there are non-price factors which are supporting the growth of exports. And at this stage, wages are not yet ruining the competitive positions.
Okay, thank you, Zornitsa, for this very deep and comprehensive assessment. I guess we can give the floor. Okay, Professor Ganev. We do in order then of seating.
Good morning. First of all, I would like to thank the presenters for presenting these fascinating, interesting research and findings and the recommendations they have formulated. And I would like to thank the organizers for inviting me to discuss the labour market research findings. So, the labour market presentation did a few things. Discussed the differences between wage dynamics in the EU15 and the new member states. It focused on potential role of EU integration, and it examined the pass-through of wages to inflation. Key findings were that indeed a major concern is about the implications of wages for inflation and the concern regarding the wage growth in the new member states and the potentially affected competitiveness. And the question raised behind the research is what are the key drivers of the observed divergent trends. Indeed, the paper suggests that in the EU15, the factors are related to inflation and productivity, and in the new member states, they're related to tight labour markets and spillovers. And an interesting White-Phillips curve is specified, and empirical findings show that it is flatter in the EU15 countries. The policy recommendations are reasonable, and they include commitment to raising inflation targets in EU15 countries and reforms to reduce skill mismatches and improve labour force participation in the new member states. However, proposed skill mismatches policy recommendations do not follow directly from the research findings presented in the presentation and the research chapter. In particular, recommendations could further consider labour mobility and specifics of wages in the public and private sector. Let me mention a few facts about skills shortages. Skills gaps are observed all over the European Union, in both old and new member states. And this shortage is a constraint on productivity and adoption of innovative technologies. According to the 2015 Skill Gaps report of CEDEFOP, 40% of the EU firms have experienced difficulties in finding skilled staff, and indeed, among them, between a half and 2/3 have faced the problem for reasons other than lack of skills, reasons like unattractive job offers. And the remaining firms, up to 50%, face the inability to find a job, to find job applicants with the right skills, simply because there is just a genius skill gap. And having the research findings presented and the skills gap situation in Europe, we could raise some discussion issues. Firstly, let's address the labour mobility. Labour mobility in the EU contributes for alleviating the skills gaps problems in the countries with higher, more competitive wages. In the same time, even without special skill gaps policies, experienced skilled labour in the new member states could be and is easily attracted to the better paid labour markets. And we may consider a case in which a new member state introduces reforms and starts investing in better education. But once trained properly, better qualified people just go to better paid jobs abroad. And if that happens, these policies could be ineffective unless that combined with reasonable labor income policies. Therefore, why not consider the EU labour mobility in formulating skills gaps policies in the new member states? Secondly, what if the wage growth in the public sector is lower than that in the private sector? What we know, in spite of the increasing wages, labour mobility continues to aggravate the problem with the skills mismatches in the new member states. And indeed, in some new member states, wage growth in the public sector is considerably lower. And if spillover effects on wage setting are considerably smaller in the public sector, then it is highly likely that high-skilled employers in high demand, for example, nurses and medical doctors, will continue leaving the sector. What follows is that the risk of having key sectors understaffed remains. One could mention health and social care, education, higher education, research and development, etc. in this context. It is clear that the issue undoubtedly undermines long-term economic growth and social development. Therefore, why not consider effective public sector wage policies? Thirdly, it is true that improved public sector efficiency is necessary. However, one of the drivers of this improvement is the human capital employed in the public sector. Without properly qualified staff, the institutions could hardly be efficient and effective. A relatively lower wage could lead to a situation in which public administration reforms are being introduced, but institutions are understaffed or their employees lack the required skills. Therefore, on one hand, skills gaps policies should be complemented by effective public sector wage policies. On the other hand, such wage policies should be prudent. So I would like to raise the question, what should be the optimal approach in solving this problem? Thank you.
Hello from me too. First of all, I want to thank the IMF representatives and the panelists for the very interesting discussion, presentations and discussions so far. I'm much more of a macroeconomist, so I'll be glossing over the microeconomic issues, where I'm not an expert at all. But I will be mentioning sort of three things in the following context. The work which is being done by the IMF in these reviews is extremely important, and the results that they have obtained and they are publishing have to be taken very seriously. This is a very valuable work. However, when a specific country wants to use these results to design and then implement actual policies, this country needs to be very careful about the way in which it uses the results. Because, for example, the estimates for the Phillips curves are based on a panel data, which means that these slopes of minus 0.4 and minus 0.9 reflect the reality of many countries. So it sort of averages out. But when you're doing policy for one specific country, the reality in this country may be very different from this estimate. And even though you can put country-specific effects and do all kinds of attempts to derive the country context, you can never get the deep context for the specific country out of such a type of regressions. So even though, again, this is very valuable, it has to be taken very carefully when policies are designed. Now, several things I wanted to mention as brief comments that are all in the direction of use this extremely variable work with an appropriate level of understanding what's behind it and with caution. For example, in the presentation on the first chapter, we had the real effective exchange rate based on unit labor costs in manufacturing used as an indicator of competitiveness. Economically speaking, coming from economic theory, it is not clear which causes what in this case. Whether the real effective exchange rate causes competitiveness or whether competitiveness causes the real effective exchange rate. Namely, an increase in real effective exchange rate may be reflecting an improved competitiveness and not a threat to competitiveness in an economy. I'll just give the example with Bulgaria. Again, I'm shamelessly going to introduce a deeply contextual observation from one specific country to show how that is possible. For example, imagine for some reason your country becomes attractive for foreign capital. There are low levels to begin with of domestic savings, but a lot of world savings start entering the country. It starts capitalizing faster than before, and the labor productivity starts increasing faster than before. And obviously, if this lasts for several years, you will see an appreciating exchange rate in real terms, inevitably. Especially if the country, for some reason, has pegged the exchange rate, nominal exchange rate of some foreign currency, and all you see is increases in the internal price level faster than the area of the currency you've pegged to. So you will see a rising real effective exchange rate, which is, however, a consequence and not a cause, a consequence of capital coming into the country and making your labor more productive, which by any definition from economic theory means improved competitiveness. And of course, you observe that the share of your country's exports in world exports basically doubles during the same period. So, current account deficit is causing competitiveness, which is causing real effective exchange rate appreciation, and not vice versa. So, the real effective exchange rate is a dubious indicator of competitiveness. It's like somebody in Mercedes saying, oh my goodness, we're selling at higher prices than everybody else, we must be losing competitiveness. No, they're not. They can sell at higher prices because they are more competitive, not vice versa. Same with countries. Now, number two, there was a lot of use of specific estimates of the otherwise completely legitimate concept of output gap, implying potential GDP, and unemployment gap, implying natural unemployment rate. Both the potential GDP and the natural unemployment rate, however, are not observables. They are not measurables. They are only estimables. And they can be estimated in 1,000 ways, and I literally mean 1,000 ways. Namely, you have at least 3 dimensions in which you can absolutely legitimately pick between different alternatives, all of them completely theoretically justified. You have the dimension of modeling the economy, whether you're going to use, for example, for potential GDP to use production function or some smoothing methods or filtering, or all of them legitimate. Kaloyan can tell you about that a little bit more. You can have functional form specifications applied to those abstract models that can be 10 or 20 different functional forms, all of them completely legitimate, all of them corresponding to all neoclassical requirements for a functional form. And then you can have 10 to 15 estimation techniques. Simple OLS, one-step, two-step, three-step OLS, generalized methods of moments, and whatnot. Non-parametric if you want. So if you multiply 10 by 10 by 10, then you arrive at 1,000 different numbers for potential output only for Bulgaria. Relying on only one number may actually lead you astray, may actually bias your observations and decisions. The same goes, of course, for the natural rate of unemployment, which is also problematic. And finally, with the estimates of the Phillips curves, what is important and probably should be included in the report is the confidence intervals around those lines. Because one line is minus 0.4, but it has a confidence interval around it. The actual line in reality, which is unobserved and unmeasured, may be somewhere within this confidence interval and may be looking quite differently, even though this is the most likely estimate. The same is true for the new member states line of minus 0.9. So eventually, instead of discussing the difference, which seems important and large, economically large, not only statistically, between minus 0.4 and minus 0.9, actually the reality may easily be that we're discussing a difference between minus 0.6 and minus 0.7, which is economically, at least it sounds to me, insignificant. So this is an important thing to include so that we see how confident we are in those slopes, given the fact that we have errors of estimations, and also given the fact that we have a panel data and noise comes from about everywhere. Thank you.
First of all, I would like to thank you to IMF colleagues for the invitation and to participate in this interesting presentation papers. I would like to say some comments which are related to the second paper on the wage dynamics in Europe. The recent labor and wage developments pose challenges and thus need to be monitored. In this regard, the paper offers a comprehensive analytical approach to explore wage dynamics based on the presenting the different trends in the old and new member state and distinguishing between the factors contributing in the short and the long term. We find the assessment of wage drivers in advanced European economies and the new member states separately is quite appropriate, since it allows for better understanding of wage dynamics. The results prove that each group of country has different challenges to address, which imply different policy implications. In the old member state, there is a room for faster wage growth to encourage the domestic demand. For example, in the analysis, in regression analysis, it's a very useful calculation on the spillovers, for example, from Germany to other countries, or France to other countries. And it is useful and use that for example, Germany and Netherlands, which are countries with imbalances, positive current account balance, but they are countries in the macroeconomic disbalance in terms of higher than threshold positive current account balance, it is useful to see spillovers, for example, from Germany to Netherlands and to Austria. And it's proved that there is room, for example, to increase domestic demand in these countries. And while in the new member state there is a need to address shortages of labor so as to sustain competitiveness. Thus, if we don't bear in mind that old and new member states have different factors driving wages, then we can make wrong policy decisions. The analysis is focused on the wage growth acceleration in the new member states in the context of labor market tightening and decreasing slack, with effects from emigration on the labor supply and wage increase. While exploring the reasons behind this development, it is worth mentioning that demography has also strong implication on the workforce and shortages of labor. Furthermore, the paper aims to analyze the crisis legacy, and it would make value added if it also elaborate on the interlinkages of labor shortages with economic restructuring and labor reallocation, both in terms of quantity and quality. This is further justified with the recommendation given to the new member state to take measures for upskilling and support the labor force participation. In addition, the analysis could benefit further if wage drivers in new member states have been assessed in the more details. As stated in the paper, even with contribution from declining domestic slack, the recent dynamics in the new member states' wages are not fully accounted for. Hikes in minimum wages and public sector wages are pointed out as potential contribution to these developments. However, the statement is not supported by a relevant analysis within the paper. One interesting and important point arises from the comparison of labor market slack in the old and new member states and their evolvement from the pre-crisis period. While the old member states still have a potential for reduced slack, for the new member states slack is even lower than 2008. If slack has reached a critical minimum in the new member states, then now the labor force participation could be further supported given slack practically covers to the potential underlying labor. Or is there a potential in some other inactive groups to be activated in the context of aging and negative demographic trends? Finally, overall, the conclusions drawn by the study about the new European countries correspond to my colleagues' understanding about the driving factors for wage developments in Bulgaria beyond the fundamental factors. However, these estimates cannot be used for Bulgaria because the country is not included in the sample. This raises the question why Bulgaria and also, for example, Romania are not included in these calculations. Thank you.